Just to give you a quick view of what I'm planning to cover, 3 key areas. Global outlook, the impact for the GCC, what's in store, and some final wrap-up thoughts. We'll kick off with where we are in the world. There is no question, very little doubt, that this year, 2022, kicked off at the beginning with a post-pandemic recovery. We had a miserable time the previous 2 years, stop, go, open, shut, faced the biggest global health crisis in recent history. We came through it. Rough, but we came through it. And like I said, we kicked off on a very optimistic note, bracing ourselves with post-pandemic recovery on the cards as economies, markets started opening from Asia to the Middle East, to the West, and finally Africa and Latin America. But 3 major strong headwinds came. Firstly, at the top, very much at the top, is the war in Europe, which has proved a trigger point in the global economy and amplified a number of headwinds, and we'll talk about some of them later, and mainly immediately overnight through higher commodity prices. Something we had not anticipated to happen in the coming years. Russia's aim. What is Russia's end game? Basically, it wants to establish control over the eastern Ukraine. Recently, you must have seen the headlines. Very optimistic, where the Ukrainian soldiers have made some headwind there as well and retreated. Some of the Russian activities have retreated in that area. However, we do not, as the Economist, see this as a major turning point in the war. This is temporary. The conflict will continue, and this is one of the global headwinds. You have to keep it right at the top still. And what you will see is alternating gains and losses on both sides in the coming months, with varying degrees of intensity. Ukraine will continue bedded down for its sovereignty, freedom, and independence. Russia, on the other hand, will continue for the survival of the regime. They've gone into a war where they do not want to backtrack either. And of course, Russia's global standing. There's a lot at stake here now. It wasn't just a question of moving in next door, annexing it, moving out. It hasn't been as simple as that. And this is one of the reasons why we don't expect either side to step down and provide concessions on both the sides as well. Yes, Western weapons certainly help and make a difference for Ukraine, and this will continue. This is not going to change. But Russia also has the capacity to carry on and push back against the recent Ukrainian wins. Russia's just started. It's a very sophisticated defense mechanism. Even if fighting dies down, and wars do get exhausted, they do die down eventually. Some take longer. What you will see is both sides will get tired eventually. It's a question of how long. And this could drag on right up to next year, middle of next year. Like I said, the intensity will vary. But we assume that the conflict will be protected, and then a permanent solution will not be reached, at least in the medium term, and maybe even beyond the 2026. Given this, we expect Western sanctions on Russia to remain. This will hurt. This has hurt very badly for Russia. Throughout the forecast period, which is 2022, 26, and beyond that as well. Can Russia reinvent itself in the future remains to be seen. Thirdly, beyond the war, 2 other factors you need to take on board is going into next year. We're already going into the final quarter of this year. You really need to start thinking about next year now as well. Inflation and monetary tightening and China's zero COVID policy. Those are the other two big elements you need to take on board. China has been a major driver of growth around the world in the past decade plus. It is coming off the boil. Zero COVID policy, with implications for global demand and supply. And you've seen that unfolding this year already. So what is the bottom line for the global economy? Another global recession was looking possible, very much possible middle of this year, when commodity prices, particularly oil prices, hit triple digits. But risks are on the rise for next year. Some major economies will enter sharp downturn. We're not talking about recession like the US, a recession in EU. One of the big things that has dominated our agenda, at least internally, and all of you sitting here, whether you're a policymaker or a corporate, there's a lot of talk about reshoring on recent events, supply chains. US-China trade war. We were talking about supply chain even before the pandemic. Tensions between US and China had highlighted the vulnerability of it all. COVID-19 added to it and aggravated the situation. What has happened is the focus has shifted with efficiency to security and resilience. All the stakeholders are moving toward how to secure their supply chains better for the future. The complete overhaul and full reshoring are unlikely. We do not expect this to happen, as moving supply chains is tricky, costly, and highly risky. It does not happen overnight. It takes a decade and maybe even more. Serious investment to change or diversify your supply chains. Companies will prioritize less risky tactics first. Very much a wait-and-see approach. Nobody likes bad news. Nobody wants to deal with this. This is big. What you will see is build-up of inventories, dual sourcing, and longer-term contracts. It will no longer be looking at just short and medium term. You'll be looking way beyond that long term. Part of sustainability and innovation. And you already see that happening in the car industry, traditional and EVs. This is today and the future, parallel to each other. Definitely, you'll see the supply chain and more diversification taking place. What you will see is China plus one more, both near and far. You will be looking more closer to home for sufficiency, self-reliant. But at the same time, the latest data for trade around the world suggests to us we're not seeing a shift in supply chain. China remains one of the major providers of goods and services. And also, China is on a path to build local production capacity. Dual circulation model. This is the new big thing in China. While rich Western states have signaled intent to build strategic sectors and supplies. And like I said, it does not happen overnight. Where you will see the supply chains changing is tech industry. Tremendous investment in the West is being pumped, particularly in the US, to become the leaders again. Expect diversification, but Asia, like I said, including China, will remain key production hub, at least in the medium term. Advanced logistics there, large local consuming market that has been rising. They are also consumers. And there will be a focus on ASEAN rather than just mainland China. The third big thing, this has come like a bad headache this year, global inflation. Like I said, commodity prices on the back of the Ukraine war, also aggravated by the supply chain and On top of that is impact of climate change as well. And Jonathan talked about it, and we touched on it briefly in the previous session. This is big. It's no longer viewed as that is something going to happen. It is happening. We're experiencing it. We have to make the changes. So what do we expect? Global inflation to average almost 10% this year. Highest annual rate for 26 years. Largely driven by the stronger pandemic coming down, recovery, demand, supply chain constraints, China, and of course, commodities spike from Russia. 3 big things there. What have the central banks done? They've bedded down. The Western central banks have bedded down and doubled down, if you could say, on efforts to curb inflation led by the US Fed, ECB, and the UK as well. You could almost say that they're a year late, so there's a lot of catching up to do. Asia did it a lot earlier. We expect further interest rate hikes. They're not good news, just when you're trying to get back on your feet after the pandemic. Nevertheless, it is the only way central banks can address the inflationary impact. Effects of adjustments will fall next year. Inflation will fall. We're already seeing a shift in commodity prices gently coming down as markets adjust as well. And typically, there's a 12-month lag for changes that to hit the economy. Bank of China will take a different path to support the economy. They are going to domestic changes there. Possible interest rate cuts next year to support their weakening economy. We're expecting something in the region of 3.3% growth for China this year. What does this all mean? This signals the end of low interest rates. We've all enjoyed a period of low interest rates. At the same time, the cost of capital will be rising when economies are slowing and debt is already high based on the pandemic fiscal spending. This has to be repaid. Whether you delay it now, kick the can down the road, nevertheless, it has to be repaid. On the same thread, what you are seeing is renewed focus on fiscal support. Pandemic, without a doubt, governments around the world did everything they could to support the population. Enormous fiscal support packages ballooned during the pandemic and they were rolled back last year when the vaccines came out, gently opening up. Governments started stepping out away from the fiscal front. But the crisis this year, energy, cost of living, have complicated the matters, and the governments have had to step back in very quickly. Whether you're sitting in the West, East, or in the Middle East, every government had to step in. Focus has very much returned to additional support. For instance, in Europe, UK's new PM has outlined almost £150 billion energy support package for the winter. It's kicking in next month. Germany announced equally euro 65 billion energy support package for households and businesses. Europe is bracing itself for a bad winter. US, on the other hand, more focused on fiscal stimulus with infrastructure and industrial, especially technology, like I mentioned, development in mind. They really are gearing ahead in that area, and you've seen almost trillions of dollars being spent on infrastructure in the coming year. So what? What does so what? This could help to sustain or return economies to growth. But temporary relief, and like I said, debt will need repaying down the road. It's a question of, do you take the medicine now and keep getting sick, or do you delay it for later? In terms of the global growth, when you look around the world, and like I've said, there is global rebalancing. We've seen the global rebalancing taking place this year. This has been in the making for a number of years, but very, very acute this year. And you will see regional variance. There'll be marked differences. What stands out in this map for you? Anyone? EU. Very much in troubled waters. This is a very different picture. North America will suffer a sharp downturn, not really in the negative territories, and it will avoid a full-year recession next year before returning to even stronger growth in 2024. On the EU front, three big players, three big boys there, are already going through their own economic conditions, severe conditions. Germany, France, Italy, and UK will also slip into 2023 of recession as the war between Russia and Ukraine on the back of the energy and cost of living crisis. On top of that is the implications of formally leaving the EU, the Brexit terms, as UK adjusts to the new world order that it needs to be in as well. That's going to take almost a decade to develop bilateral relationships out of the umbrella of the EU. All of this is going to prompt tighter monetary policies. Undoubtedly, it has an impact on households and businesses. On the other hand, and positive, when I talk about rebalancing, this is where it comes in. Faster growth will be found in Asia, China, India. Ukraine-Russia war has not directly impacted the Asian economies, indirectly through the higher commodity prices, particularly energy. Middle East, especially GCC, and parts of Africa, smaller, more dynamic, intra-regional connected countries, plus major commodity traders. These will do well, and you can see the split taking place in terms of the rebalancing. However, you can see where I've circled as well. China is struggling with COVID clampdowns and real estate issues. They've still got to deal with the property issue, and the economy is slowing down. Government is looking to manage its way through the soft patch. Zero COVID policy, periodically you'll see certain provinces being shut down for like a week or 2 weeks. You'll not see anything like we saw during the pandemic, long term. Nevertheless, it does hurt. Similarly, the trade picture will remain very uneven at the regional level, in line with growth and the supply chains. Also reflecting divergence very much across the economic performance, developing markets. What is different is you will see Asia trade continue. Inter-regional trade is still very strong. While the West will continue to go through a period of recession, weaker conditions, the rest of the world will not be growing as strong, but nevertheless, they'll be in positive territory. A quick look at what are the top risks for the global economy. Busy map. We've highlighted some of the risks so you can take it on board, which could potentially, this is not our central scenario, by the way. These are alternative things that can kick in. Unpredictable circumstances, unpredictable events like COVID can kick in and completely turn the whole world upside down very overnight. So some of the risks involved, unresolved war in Europe, of course, and that is going to keep the energy, commodities crisis much higher. This will be acutely felt in Europe, but elsewhere too. Fresh outbreaks of COVID, it's not out of the woods yet. It's still there. Not as severe, but very much there. This could stall recovery as well, particularly a major issue in China, and importance for the global demand and supply here. And the supply chains, like I talked about, runaway inflation and much tighter global financial conditions. These things, particularly inflation and tighter financial markets, could undermine investments around the world as well, just when we are starting off. Geopolitical tensions are never far behind, particularly between China and the West. Cybersecurity. This is going right up the agenda for us. It is, you cannot see it. The damage it can do is pretty severe across the economy and for the corporate level as well. You're going to see trade wars, potential trade wars, decoupling, retrenchment. These are just alternative scenarios that could unfold and become central. This is not our central scenarios at the moment. Okay, now for the good news. What's in store for the GCC? And I'm very glad to say, for the first time, you can see the chart on the left-hand side in purple. Those are the GCC countries. GCC countries led by Saudi Arabia and the UAE are outperforming the G20, the world's leading economies, including Asia, China, India, and will place the bloc among the fastest growing regions this year. A major short-term bounce on the back of the bullish energy market involving high prices. It's more than just energy, and I'll come to that. Strong demand for oil and gas as the economy started opening up. Medium-term prospects, very bright. And although there'll be some slowdown, you cannot completely ignore what's happening in the West and think you'll be all right, Jack. It will be there. The impact is there. They will grow, but not as strongly as they would like. They will grow in the region of 2 to 4% on average from 2023 to 2024. This is just the average for the GCC. And each country within the GCC bloc will perform at different levels, but all will be positive. Quite remarkable, you can say, given the turbulence in the world, some of the things I've just highlighted, and softness of major export markets. Nevertheless, what's driving this? What is driving this? Still upbeat energy exports, large financial buffers. Sovereign wealth funds are in a very, very strong position this year, trillions of dollars. The buffers have been rebuilt very quickly. This is something that was not anticipated. Major investment plans, diversification, and reforms. And very much, I would say, there is a vision, a long-term vision. It is not about dealing with a crisis or a situation just today. There is Vision 2030 across the GCC countries. Each one has different objectives, agenda. Nevertheless, all of them are more or less moving in the same direction. In other words, external headwinds, but internal drivers will remain intact. You will see dual speed scenario is playing out across the regions in the medium term. What I mean by dual speed, you will see depending on the dependency of the energy, but nevertheless, diversification will continue. There will be a little bit of slowdown, but the big ticket projects, infrastructure development, all of that is going ahead. Manageable external headwinds. I've already mentioned that, but what you will see is oil and gas markets may come off the boil, but demand for the region's energy will remain fairly strong. This is still a major supplier of fossil fuel. Yes, renewables, alternative, all of that is going ahead, but nevertheless, fossil fuel is still going to be remaining the key energy need. Also, at the same time, prices will be fairly high by historic standards. They're not going to be in the triple digits, $100 or $120, but around $80 to $90. And investment that has been taking place in recent years and ongoing will increase new production capacity. The region will look to develop new technology and definitely expand their new markets as well. Two more reasons other than exports of energy that will withstand the global headwinds are, as I mentioned, the large financial buffers that can afford to spend. It's a deep pockets there. They have been rebuilt in recent years and strong inflows of foreign capital, FDI and FPI to major projects. You can see the number of ticket projects that's going ahead this year in the first half of this year. They're mushroomed by almost over 100%. There is confidence in the region's future. This counts a lot, investor confidence. and its opportunities amongst both the foreign and domestic investors. And what you're going to see is increasingly diverse network of trade and investment partners as well. It's no longer going to be just West, it's going to be West and East. In terms of investment, very briefly, I'm mindful of the time. GCC states, as I said, are speeding ahead with a number of projects led by Saudi and the UAE, two big players. They're sticking with major investment projects, particularly also expanding their energy, build industrial bases, and drive new growth engines as well. Pipeline is busy and immense, and this will be the pillar of future visions for the region as well. There is a strong will to stay on course, to ensure that growth continues and diversifies, especially in the two big regions. The other big sector you've got to think about is what has been driving this growth will be business reforms. Both UAE and Saudi are moving up the global business environment rankings. And what you're seeing there is our own business rankings. We rank 82 countries around the world, including UAE, which is now positioned 15th, and Saudi is 41st for the period of 2023-27. UAE has gone up 9 places in the recent rankings that we did, and 5 places for Saudi, compared with 2018 and 2022. Pretty big jump. The jump is also partly because the European countries are not forecast to do that well in the coming years. So there's an element of that there as well. Reforms are broad-based, but very much focused to make it easiest to start and do business. And it's only just about starting and doing business, it's about staying here to do business. Sustainability, this is the business hub. Making it attractive for foreign investors, one-stop shop, and promoting more dynamic domestic businesses as well. There is growing competition within the GCC, and particularly between the two big players, UAE and Saudi Arabia. And competition is good, keeps you on your toes, it's healthy. To secure the lead as a trade investment business hub. This will continue, but the competition, like I said, is positive. Why? It is because of the pragmatic side of GCC. They will create cooperation. For instance, in 2020 and 2022 this year, DP World was awarded a 30-year contract to develop the Jeddah Islamic port by Saudi Arabia. So there is close cooperation as well. Dubai, without a doubt, it will retain the top business destination in the region, very much benefiting from being the first mover advantage, advanced infrastructure, ongoing reform, strong international connectivity, and a very clear path for the future. They do not stand still. It is a moving target as it implements new reforms, builds new developments, businesses, and relationships across the world, and enters new market. This is very important. There's a very strong focus on supporting a thriving, dynamic, entrepreneur business community. And all of you who have been in this part of the world for a number of years, you've benefited from some of the visa changes that is taking place. Tax reform is on the horizon, with the introduction of corporate income tax, CIT, which is scheduled to come into place next year, June 2023. This should really enhance Emirates' standing as a legitimate international business hub, rather than just being viewed as a tax haven. It has to be part of evolving and maturing as well. Very quickly, tourism has regained the momentum. A corner appears to have turned this year, and we expect it to continue to build. You will see a slowdown in line with the way the global economy is going, particularly in the EU, but certainly it is on the right track as well. And this will be aided, we've heard about major events already, promotional campaigns. All of these combined will keep it going. Final thoughts, quick wrap up. GCC is confronted by complicated external environment, but it is well placed to withstand it. it's not going to come at a standstill. All the key areas, travel, tourism, religious, all of that are fundamental to long-term growth there as well. And plans are moving ahead, and they're firmly on the road to recovery. I'll go for the final wrap-up. I've highlighted 5 big things you need to take on board. You can view it as risks, but risks equate opportunities as well. Current events are clearly shaping how you're doing business today, tomorrow, and the day after. And this will have a spillover effects on the GCC as well. Insecurity is driving up defense spending again. Alternative financing systems are developing as well. And more focus on green solutions. Technology development will continue. And commodities prices are here to stay. Bull run will last some time. And you will see some instability there from time to time. These trends are not new. But what I'm saying is the current events are turbocharging them. So 5 big things there. Closing remarks, very much clear. For the first time in 2 decades, you have seen the return of inflation. And countries are suffering above 5%. This is not going away. It get better, but we won't go away. What is important is today, the 25 largest emerging markets, from UAE to India, are in a strong financial shape. Inflation will ease back, leading economies in the GCC to continue to grow. Financial clout, very big. You will see it push ahead with diversification. And for the first time, the developing and the other world, inflation is a lot lower than the developed world. 3 R's. Recovery, rates, and risks. This will dominate your business agenda in the coming years. Just before I wrap up, because I've run out of time, unfortunately, a polling question, a quick polling question. What really keeps you awake at night? Is it interest rates and inflation? Or is it the impact of the climate change, which is going to unfold in a number of ways if we do not do something about it? First one, inflation, interest rates, raise your hands if you think that's what keeps you awake. Climate change. Second, well done. Inflation will get better. Climate change? No. We've all got to work together to make it happen. Thank you very much for your attention.